Welcome, lady and gentlemen. Lady, Nick, I did it again. The bloody lady. Why can't I produce the S after ladies? Welcome, ladies and gentlemen. Maybe it's because we only have so few female viewers
Possibly.
or course participants. Anyway, welcome very much to our new issue of the Grey Market Talk with Nick Themistocles, a portfolio manager, fund manager, former trader, market vigilante extraordinaire, and the sane guy I go to if markets carry me away. And with me, former market maker who actually doesn't care too much about which direction markets go, because I always had to sell the hot stuff and buy the crap stuff. So markets, in my view, are mostly random, but maybe not. That's why I speak to Nick to figure out what's going on. Nick, thank you very much for your time, squeezing me in before you have to golf tournament.
I have a golf game, not a tournament.
Well, everything is a tournament when you play golf, right?
You
Against yourself, latest.
We play by the rules.
So yeah, let's get the charts up. We try to keep it brief to not keep you too much distracted. Grey Market Talk, the 3rd of March in 2024. You know, when I was young, I thought in 2024 we have flying cars and rocket belts and stuff. We don't seem to have that, do we?
Not yet.
We seem to have confusions about gender, you name it, everything that's out there. A very, very strange time. Anyway, so I didn't get what I wanted as a little boy. No rocket belt. I would have one now, by the way. So, let's start with the usual disclaimer again in today's Times. Artikel 5 Grundgesetz. Jeder hat das Recht, seine Meinung in Wort, Schrift und Bild frei zu äußern und zu verbreiten. That is our freedom of speech clause in the German constitution. I thought nowadays I have to slip that in because most of the stuff we are uncovering or discussing are not very favorable to the guys in charge at the moment. And the guys in charge at the moment do not like that. They like warfare, lawfare, as it seems warfare as well. We come to that later, maybe. So I think it's appropriate to slip that in. And yes, of course, I'm trying to do journalism with own opinions, and this is my press identity card, just to keep that in here. So, Neue Zürcher Zeitung, the Swissies, the guys who I read most at the moment, if you want to have a correct presentation about what's really going on. And it says Stellenabbauer, Bayer, Bosch, SAP and Co. Deutschland im Katzenjammer. Germany in a big pickle because everybody is firing people. Nick, you're in the UK. What's the UK press, papers, local media? What are they saying about Germany? What is their feedback in the papers?
Well, they're actually too busy discussing their own problems, I must say. But but we spoke about this last week. I think more and more people are happy to be outside Europe, and everyone looks at Germany and says that this was the engine, this was the powerhouse. It's not anymore. Go and look for another powerhouse. It's in America. It's somewhere else, but it's not in Europe.
Is it not in the north of England, the powerhouse north, or whatever you might?
I don't think so.
I've just heard that the Labour Party lost a seat in Rochdale.
Yes, it wasn't. They didn't lose it, but they had what I read in the papers was basically a Labour candidate who was very, very to the what do you call that? Left side, right side? George Galloway. Yeah, I mean, this is a very, very well-known politician who's well-spoken, very articulate guy who was kicked out of Labour because he was against the Iraq War. History was actually on his side. He was proven right that the Iraq War was justified on what he called a pack of lies. In the end, I think he was right, but he was kicked out, and he's found his way into Parliament as the UK Labour and Conservatives still trip over themselves as to how to deal with this conflict in Israel and Gaza. They just don't know what to say. And if somebody says the wrong thing, they get upset with their own politician. So they kicked out their own politician for saying the wrong thing. And that left the door open for George Galloway as a, I can't remember what the name of his party is. It's not...
Respect, I think.
It used to be Respect. I think he is now something else.
All right.
And in second place, there was an independent candidate, not a conservative. So Labour didn't they did participate. Actually, Labour did participate. It was too late for them to actually take his name off the register. So the Conservatives, had a chance to come second, perhaps, and they didn't even come second. So an independent came second. So the Conservatives came in third, and then I think Labour were in fourth, and all of this stuff. And I think they're all in a bit of a tiz in the UK because this has really put the cat amongst the pigeons. And it's forcing the politicians to really think about their own foreign policy, what the people will support, what they won't support. And they just haven't got it right now.
Well, thank God you still have the Monster Raving Loony Party, which is an established party since, I don't know, forever. Never gets a lot of votes, but a lot of fun. I think sooner or later, if the traditional parties will continue with that rubbish, people like if I would be a Brit and would be allowed to vote, I would definitely make my mark at the Monster Raving Loony Party. Yeah, well, why would I vote for the other?
You don't need to be a loony to get in these days, and let's see what.
Well, as a former market maker, people might identify me as that.
This is really a wake-up call for politicians, right? In these traditional parties, you have to listen to the people, you have to deliver something, and I think again, this is probably controversial in Germany. The response in Germany is, well, if the people sort of vote for something that we don't like, we'll try to ban them or we won't work with them. You know who I'm talking about. And, that's just a real shame. It's not really democracy.
No, well, Bertolt Brecht once said, if the government doesn't like the people anymore, the government will simply vote for new people. So we might come up with something like that. Leads us nicely to what we have going on in Germany. ThyssenKrupp, you remember we even mentioned that a couple of episodes ago that they had this dream of green steel. We can, because our energy costs are so high, all the German steel manufacturers who are already heavily subsidized can produce green steel by simply taking the sun, split water, have hydrogen, and then use that, coming back to a ratio of 1:3 or something, like picking up coal in the woods or forest in the woods, wood in the forest. Now I've got it. And burn that. And ThyssenKrupp said, yeah, they're going to slash 5,000 more jobs. That is something clearly our government at this point in time did not want to hear, especially as our Vice Chancellor, Mr. Habeck, a couple of weeks back was in the south of Germany and giving some steel mill another 3 billion in subsidies, to help them to transform into that region. So yeah, fine. That's what's going on all the time in Germany at the moment. And we have here from Bloomberg, the number of German unemployment increases more than predicted, which is very interesting because we predicted that months ago that they would go up, without any doubt. So more than predicted. Well, it looks abysmal. It is abysmal. And we know why it came in, because Germany is structurally destroying their industrial base. That's what we're seeing here. At the same time, we are whinging on about we don't have enough qualified employees in Germany. Can you riddle me that? How does that work? You fire 200,000 highly trained, highly skilled, highly gifted Facharbeiter, we call them, professional workers on the one side. On the other side, we are selling the narrative, we have too many, we have too few qualified workers. We have to import half the world. How does that work?
Yeah, I've never understood this argument about we don't have enough people. You have far too many people doing unproductive stuff, whether it's in bureaucratic functions in government or whatever. You have plenty of people. You just need to train them. And here, this is an example of German industry being destroyed, and the workers in Germany having to find something else to do.
Yeah, well, I think, thank God for that. Oops, I went too fast. We've introduced a new law in Germany to help that calamity, the Growth Opportunity Act, which is now in the second chamber in the German parliament, in the Bundesrat, and it will give 3.2 billion euros by mostly tax reductions for companies back to help, as it says, to enable growth in the German economy. So 3.2 billion, we did the calculation earlier while we were in the green room. If we have 15 million, population of 82 billion, 15 million were the numbers of net taxpayers in Germany. That would equate to 213 euros a year, 213 euros a year. which the state is giving back by enlightened things. If you're an entrepreneur like you and I am, if I invite a business partner for lunch, I can only deduct 50 euros from that business lunch I had. Now it's something like 75. So I've already thought, great, I'll wait another year and invite him and his wife maybe. And that will help my business dramatically if I get that shifted up. If we divide the 213 by 12, that equates to 17.77 € a month. So that's bloody awesome, right?
Whoopie-doo.
Yeah, well, in the
Let's go for it.
while we are blowing away 3.2 billion euros on the Growth Opportunity Act, we are paying 50 billion euros a year for migration and its follow-on costs we have in Germany. These are the numbers from the Welt, one of the well-renowned broadsheets we have in Germany. I don't want to come into trouble anywhere to say, oh, you're exaggerating. These 50 billion is health costs. You have to feed the people. You have to give them education. So it runs up to 50 billion a year, right? And then the Ukraine war, that was the latest figure since the whole malarkey started. Yes, bless the Ukrainians. They have been attacked by the Russians. They have my full sympathy. But Germany paid about 200 billion euros already, or these are the costs associated with this war for Germany. And Mr. Lindner, our finance minister, was on the air last week and said, because somebody said, oh, Germany has to pay more for the Ukraine war. And he said, wait a second, of all contributing countries in the world, Germany is already paying 50% of the whole bill. So puts that 3.2 billion a little bit in perspective if we look at what we blow out of the window in the meantime. And that's the point actually I was leading up to. Meanwhile, the DAX. This is a logarithmic chart because I wanted to have really this long-term growth trend in there. And Nick, how do you explain that to me? We see what's going on. We have the highest taxes. We have the highest energy prices. We have politicians who don't seem to be really good in what they're doing. Meanwhile, the DAX is making new all-time highs. There has to be a reason for that.
Yes, absolutely. And that's a great question. Well, I would just simply say, for me, this is, almost like gold, almost like Bitcoin, almost like anything else. If you kind of lose faith in the government or in your currency, you've got to go and buy stuff, and your cash is useless. So, whether you buy stocks, whether you buy gold, whether you buy crypto, whatever it is, you have to get out of cash. I think that's kind of, one argument. Of course, there's the other side of the argument. There's a lot of foreign money coming into this country from people who actually think that there is value in the DAX, and maybe there is, but they're certainly paying many years of forward income in the price. So the value of the DAX today, how many years worth of income are you actually discounting at this price level? It's certainly a level where it's not interesting necessarily to buy. I don't like buying things after they've gone up. I like buying things after they've gone down. So
yeah, I'm with you. By the way, the gray lines here are the US recessions I put in this chart. And obviously, Germany's growth in the last quarter was 0.2%, which is, well, pretty much faked, I would assume. So we are already negative. We are already negative for what I think for a couple of quarters. When the history books once will be opened, I think where we are now at the new all-time highs, you'll pretty much see a very long extended gray line if they do not 1984-like fake the history, as we are trying to do now as well, as it seems. And that doesn't give a good forecast for the DAX. Having said that, I'm entirely with you, because if your money isn't really worth anything and you've lost the trust in the government and the politicians, and inflation, they will have to print money eventually, and they will have to lower the rates, because otherwise we can't finance all this crap out there. That means, yes, we are pretty much in a stagflation environment. And a stagflation environment, you have to look after your money, right? So the best idea is to, if you foresee the future, put it into some real hard, cold assets.
Look, I mean, you can see that the markets go up until they're interrupted by some economic disaster. And if there's no economic disaster, then financial assets continue to do well. They always have done for, 100 years. And then you get this interruption, you can see that with the vertical lines here, which I guess are the recession points,
US, yeah.
go up until it's interrupted. And, perhaps there is still this belief that the world can escape a full-blown recession. Certainly, the good thing is that China seems to be coming out of the worst. Certainly, a good thing seems to be that all those doomsayers about the US recession were proven wrong. And now they're all proven wrong. They all have to jump back in and say, well, okay, then I need to go and buy some stuff.
So you as a portfolio manager, somebody who is looking after his own money and advising professionals on how to invest, what would you tell them? Would you say, hey, DAX guys, that's where the party continues, or take some profits and run? Or
the thing to do is you have two ways to play it. You can either try and pick the top and say, look, we're in the zone. For me in the S&P, I'll take the S&P because, I can sort of relate to the levels there. So in the S&P, the levels that I kind of viewed early on was between 4.8 and 5.2. We look like we're heading towards the upper end of that range. Yep. In this range, I do not buy. And in this range, I would be looking to offload. And so, that's one approach. The other approach is to say you stay long until your signals, and I've got some technical signals, which effectively say to me, and the stop loss goes higher and higher. Last time we spoke, it was 4.8. Now it's at 4.9. Whilst you trade above 4.9 in the S&P, you're still okay. So you can play the thing as a long trade until the market reaches a point where you say, okay, you've triggered that. But one thing you shouldn't be doing is to say, okay, I'm going to look at leading indicators and stuff like that and say, oh, there's negative growth. Oh, that means I've got to sell everything. I think it's the wrong thing to do. Sort of equating the economy with the stock market is just something, you'll get very, very confused about. And it's the kind of wrong way to to invest. Because the economy could catch up to the stock market. I mean, that's, fundamentally, you have to think which one is leading what.
Oh, I've heard a great slogan in Germany, which is coming out of the industry. It says, survive till 25.
Yeah, that was me, actually.
When the next election.
That was one of my things. Basically, you're good till 2025. I do think we're going to get correction. I don't think it's going to be a crash. I think we get a correction, this year, not a crash. And then, end of 2025, you're still good. Thereafter, I'm sort of very, very worried. Thereafter, I would say, I would be, I'd say that's it. Time-wise, cyclically, I think that's the point where you should be selling it. So the next couple of years is more for trading. There's a little bit left in this thing. But if you only got in at the top, there's not really much, you're not going to earn very much between now and in a kind of a risky environment, frankly.
Yeah, I agree. It's let's close the unfortunate chapter Germany with one of the great tabloid newspapers for private individuals, investors, I spotted last week. Is there an indicator here somewhere in the Focus Money title tells you a minimum 100% up to 1,000% returns possible? And it says in big letters, hot, hot, hot on the right, and analyzes the 25 hottest Aktienkracher, the best stocks you could possibly have in an exclusive analysis.
Yeah, my sort of belief on all of these newspaper recommendations, and I know people who follow these newspaper recommendations, they kind of work for a very short period of time, but by the time they're in the newspaper, you're buying this thing after the smart money has already got into the stock. And you really want to be buying stocks, when people don't want them and not buying it when you read it in a newspaper. And, if this thing says, let's go into a super micro computer now, or NVIDIA now, or all of these things now, then I would say, go and buy another newspaper. You really do need to sort of think about what your investment choices are. It's trading. I would say this is momentum style, and picking hot stocks means you're a momentum player. So you play it like a momentum. You need to be long. And when you hit a signal which basically says the momentum has gone, get out.
When I was at the university, long before the internet, as a young man, I started collecting title pages from the big tabloids, at market lows and at market tops. And it was always like this. You had the absolute greed foaming of their mouths. People were thinking about, how can I have the next stock that makes 30% in one night, and I leverage that up with options. That would usually met a market top. And when nobody wanted to have, I remember the big titles, Germany, the sick man of Europe, you can't do anything. I remember the same when I was at university, when they had this line about the United States, worst country in the world, can't invest in it anymore. Was right at the bottom before the big bull run started. So yeah, I focus at these titles at contra indications, big ones. I can see if it has filtered down to the man on the street and everybody is looking for the 1000% returns, not the, Germans used to be the people who put their money on a Sparbuch, a loan and savings account, where they were happy with 2% interest a year. And now they are chasing 1000% returns. Well, you live and learn. So it brings us to the United States of America. And I had this beautiful meme in my inbox. You actually see a very dodgy looking balcony on a small house, and it has two pillars supporting it. One says Taylor Swift and one says NVIDIA. Obviously, Nick, I want to ask you about your opinion on Taylor Swift. What do you think? How is her impact on the US economy?
Well, let's talk about the US economy, something I might know a little bit more about than Taylor Swift, but only marginally. Firstly, when you look at the GDP forecasts, they have been very high. But recently, what you're seeing for GDP now from the Atlanta Fed is estimates have come down for Q1 of 2024 from something like 3.8, ridiculously high, and now it's about 2.5. Something like this, 2.3, 2.5. So, concern number one. Concern number two that I've got about the US economy, and I haven't been really concerned about the US economy at all for the last year, but concern number two that I've got is that the gap between the other measure of growth, so not GDP, which is an expenditure measure, but the income measure, gross domestic income, is very large. The gross domestic income in the States for Q4 hasn't been announced as far as I understand. And the latest number for GDI is somewhere around zero. So we had GDP for Q4 was about 3 and a bit. GDI is about zero. So what's the truth? And the gap between the two, I haven't managed to find a sensible reason. I've been searching high and low on the internet, a sensible reason for the gap between the two, and which one is likely to be more right than wrong. Now, when you look at how the US authorities take this thing, what they do is they simply average the two. And historically, the gap has been fairly small, 0.1, 0.2. When you average it, you don't care. But if the average is 3%, if the high and the low is 3%, and the average is 1.5%, that's a huge difference to where you might expect 10-year yields to be. And if you think 10-year yields gravitate to, let's just say for the sake of argument, to nominal GDP, and your nominal GDP, you don't know if it's 3%, if it's zero, if it's 1.5% as an average, that's a substantial difference. So this, for me, is one of those rickety sort of little sticks that you've got holding up that balcony. What's the number? I don't know. When you look at employment still seems to be growing very, very strong. You look at construction employment, you look at all of these things, you say, okay, people are still getting hired. But as we know, employment is the last sort of thing to kind of break in this thing. So even though I've not been concerned about the US economy, I'm starting to be a bit worried because I just don't know what the numbers are anymore.
Yeah, because these numbers fly in the face of everything you and I learned in business school. GDI, gross domestic income, should be pretty much like gross domestic product, because what you earn, you spend, and what you spend gets into earning converted. So if you have this huge gap in there, something seems to be off track. And I have a couple of charts here. Thank you very much to my friend Eve, fantastic macro analyst. He's always feeding me these lovely little nuggets in here, and that is a chart which actually shows us the delinquency rate on credit card loans. Yeah, for all commercial banks, these are the lower charts. They seem to be in line. They're going up dramatically. Yeah, if they have bottomed out at well, what is that, 1.5 in between around 21, they're now at 3. They have doubled, and the red line is the most interesting one. These are the banks rated not 1 to 100 largest in the country. So these are usually the smaller banks who have to employ their credit card business to a different audience. Yeah, they get customers who else wouldn't get credit someplace else, and then they pay an annual return, annual rate of 30, 40, 50, 60, 70%, and they seem to be completely maxed out. Yeah. So they're running out of money. And thinking a little bit further, these are the people, due to their economic situation, who spend 100%, or as we can see here in this case, more of what they earn into the economy, yeah, to keep this whole thing up. Coming back to your gross domestic income, if income is not going up, yeah, that makes complete sense that the delinquency rates go up. And if delinquency rates go up, you're simply running out of fuel to fire up this economy. And the next chart makes the combination out of that. United States retail sales year on year. The remarks here are from my friend Eve again, who put that in. And he simply said, is there a recession soon? Putting that all together, Nick, you said you are getting more cautious about the United States. Do these numbers point in the direction that sooner or later this no lending or soft lending turns out to be a myth?
Well, I mean, they're in a very the Federal Reserve, if they steer anything, I still don't know what they steer other than, you know, very, very short rates in America. You know, they just don't know what to do. They don't, you know, money supply is slightly increasing, which sort of raises again the specter of potential resurgence of inflation, or at least it stops going down further. And so, you know, when you say it's not going down and maybe it goes up a little bit, and then they start to cut rates, and then suddenly, you know, the next print is higher, what do they do? And I think, you know, the thing that causes recession is uncertainty at the end of the day. And this is not really a time where you need uncertainty in an economy. You need certainty. You need to know that there is, you know, you have confidence as a business to spend, you know, that there's no, how do we say, legislation that's going to go out there and interfere with your business, or there's no suddenly shift in policy from central bankers. And if central bankers firstly have kind of said to you at the end of the last year that, you know, they're looking now to cut rates are peaked, you know, be confident, and then suddenly everyone says 6 rate cuts, and now they're saying 3 rate cuts, and maybe there is no rate cuts. You know, it's this uncertainty that really doesn't help people, I must say.
What fits, sorry to interrupt you, but what fits in quite nicely, because durable goods numbers came in far worse than expected last week, and nobody seems to have made a big thing out of that. And I think when you speak about uncertainty, isn't that exactly this? If I run a big industrial complex, yeah, factory or stuff, and I have heavy capital incentive spending on machines, and I hold this back, isn't that exactly proving that the confidence into the market is massively waning?
Yeah, I think, you know, as I say, I'm reaching the level of concern on the state of the economy in the States, and as we saw from that DAX chart, things go up until people, how should we say, have massive concerns about the state of the economy, and until the economy kind of flips, and then suddenly you get caught, you know, wrong-footed as an investor, and that's why for me, you know, with this kind of GDI and GDP difference, and we don't know why, and then you get sort of, you know, Eve's chart here, which kind of signals that, you know, not all is well in retail sales, and we know the US is a 70% consumer-led economy. So, you know, then what happens? And I'd say, you know, I wasn't sounding like this at all in 2023. You probably remember I was sort of all gung-ho and saying, ship it in, don't worry about it, you'll be fine. But now I must say, I don't know what's happened. Maybe I've eaten the wrong thing, but I'm suddenly getting a lot more concerned about the state of the US economy, and I need to see something which, convinces me that, all is well, but I'm not seeing it.
Yeah, well, you have the perfect Bayesian approach. Huh? If new data gets added on, we shift our view about the situation. And so far, with the S&P making new all-time highs and the economy not cooling down, yeah, soft landing, scenario was right. Another chart on here is the average weekly hours of all employees in manufacturing and all employees total private. We mentioned Jeffrey Gundlach a couple of weeks ago, who already gave the analogy and said, that's usually what happens. We had hoarding of workforce. That's why employment looked very good. People were not, or factories, employers were not firing. They were hoarding labor in this case. What's the next step? When things are not looking as rosy anymore, they start reducing hours. Yeah, overtime was first cut, and then they reduce the contracts from, let's say, 8 hours to 6 hours to 5 hours, and eventually they'll reach the point where they have to outright fire people or let them go, how the euphemism goes. And this is, I think, well, a very interesting chart if I see that the weekly hours worked are coming down massively in this scenario. Every time when we have seen a recession in the past, that happened beforehand. And the last of these charts, the industrial production in the United States on a monthly basis, is also quite nice. You see, we seem to reach a top level right before we see a correction in the economy as well as in the stock markets. And we've seen the industrial production actually topping out at beginning of 22. And the question is, as always, what's next? Do we see the move into recession, or can we afford to work sideways a little longer? And that's where the interest rates, what you mentioned earlier, come in again. Higher for longer. Higher for longer doesn't entice people to spend a lot in capex, durable goods, because the confidence is gone. They start firing people. Delinquency rates are high, and the market is an absolute bloody froth here. I have been bearish for a while, yeah, because I was let down the, how do you call it, the wooden path by the leading indicators, which didn't seem to work as a model anymore. But looking at the real data now, with the froth I can see in the markets, I'm getting more and more pessimistic here. Or am I too pessimistic again, Nick?
No, I think it's fair, but I don't think interest rates necessarily drive the economy. I think the interest rates reflect the state of the economy, and if you see interest rates continue to rise higher, I think that sort of gives you more confidence that the economy must be growing. I don't believe it sort of that interest rates kind of impact the economy to any great degree. It impacts certain sectors like real estate and projects like that, but when I look at sort of the data of, as you say, I think the chart before this one about the hourly, the average hours. I think that's exactly the point about hoarding workers. The first thing you don't cut the workers, you keep the workers, you put them on lower hours, and I think that's an indication that things are not too well, and everywhere I've been looking and everywhere I've been believing, the GDP numbers. And until I saw, for some reason or other, the GDI numbers, I was like, what the hell? What? And now I'm looking for stuff which basically tells me that perhaps growth isn't as strong. And we should start to see that with a rallying bond market, frankly, rather than a falling bond market.
Well, we had a couple of rodeos in our lifetime. It's usually that everybody starts, or let's put it that way, people who are interested in focusing on the market start seeing what is going on, and everybody seems to ignore it until at one point in time everybody suddenly sees the data, and then everybody tries to do the one thing they're going through. Maybe we're not quite there yet, but brings us to the sentiment in the market. And I found this beautiful chart of from Hedgeye. Started with a magnificent 7, then it's crossed out 6, 5. We're now down to 4. Yeah, we see new all-time highs in the S&P, but Apple is not really moving anymore. Yeah,
I hate Apple, you know that.
Well, I was cautious about it. I thought I wanted to see their super Vision Pro glasses, and I'm the kind of guy who is happy to spend that amount of money if I think I get some added value out of it. Like a Tesla, not buying one anymore, not even thinking about buying one anymore. The Apple product, now let's wait for the second or third iteration. At the moment, it looks just ridiculous, this thing. So I'm not going to spend $4,000 on it.
So who are the four? I mean, Nvidia, Meta, it's not Google anymore. I mean, if you say Google is there, then you can make that magnificent three because Google screwed up with their AI. We talked about that last week.
Oh,
Google
that was
shouldn't be there.
absolutely awesome. No, but NVIDIA is there to save the world. I think we had that as a chart on there as well. That's the option premium spent on top stocks for the week.
Right.
Last week, that was, yeah.
Yeah.
So NVIDIA, you can see, yeah, NVIDIA is chasing the market makers at the moment. We have to sell the calls to our happy customers. And obviously, we like to be hedged. So if the market goes up and I'm short a ton of calls, I have to buy the stock to stay neutral. And that's what we see. You mentioned earlier in the green room, super microcomputer. They're now on the S&P, you told me.
Yeah, I think they're going to be in the S&P as of Monday. If I understood the headlines, I didn't read into this thing. They're going to be in the S&P, and that explains the kind of the big push up after hours in Supermicro. So they're going to be there.
We are playing the earnings seasons at the moment quite heavily. And so far, we've been very successful until last week. I had the usual earnings trade on Dell. Yeah? As I'm a bit of a coward, I always buy the wings. Yeah? Thank God, I'm not selling strangles. I buy the wings. What are the scenarios? You look at it, and I remember the good old days, or in, how do you call that? Hyphening it, the whole thing. A stock that makes 30%, not going to the market maker move 10, 12% or NVIDIA 20%, no, 30% the next day. This is clearly the beginning of a very conservative bull market, is it, Nick?
Well,
I'm being facetious here. That's obviously.
I know you are. I know you are, and I know exactly where you're coming from. We are in a trading market and not an investing market, and that's why. I stress when you talked about sort of where are we in this thing right now. I think at the end, when we're at that end phase, and you're in that sort of target zone, you can't invest because you invest, you buy and hold, you buy a lot of stuff, and when you want to get out, it costs you a lot of money to get out. So you have to be flexible, and I think that's why options are sort of a great tool to kind of play in this market environment. You've got to trade.
Well, it protects you from losing your house.
Absolutely.
Brings me to the fear and greed index, because usually we only show the top line that we are, well, I'm not telling any market secrets, we are in extreme greed, but the sub indices, which the CNN fear and greed index is composed. Yes, there's a lot of discussion. Is it the best one in the world? It's a good one. I like it. And market and momentum, if we go through the subsectors, in extreme greed. Stock price strength, extreme greed. Stock price breadth, greed. Put and call options, extreme greed. Yeah, nobody seems to be wanting to hedge anymore. Market volatility is only neutral. On a longer scale, I would say we're also in extreme greed. If a VIX is trading around 13, 14, that doesn't tell me that the market is very much worried about what's going on here. But what I wanted to ask you is here, and I found that very interesting, the junk bond demand. Obviously, normal bonds, extreme greed. Junk bond demand, extreme greed. A junk bond is debt issued by a crappy company. Let's call them crappy companies. Yeah. So they have to pay high yields to actually being able to borrow money from customers, and customers don't seem to be adequately paid for investing in this. Well, superior risk in these products anymore. Yeah, they will all be happy. Interest rates will go down to zero again. They can run another refinancing cycle. Is that the reality we are seeing here? You're obviously much more connected to the bond market than I am. Are customers still out there and say, "Fine, I buy everything where I get a little pickup in yields, even if it's."
I mean, I think you say that crappy companies, okay, but. I think this is your canary in the coal mine, as it were, because if yield spreads on junk paper or high yield paper is very, very narrow, it's narrow because the people who are buying this stuff don't see a recession down the road, and obviously, if there were a recession down the road, these are the companies that are likely to get hit, the hardest. They'll struggle with refinancing. The financial statements are much more vulnerable to the economic situation. And so, whilst what you're seeing here is that those people who are investing in this stuff are basically saying there's no recession. And, they may be right. As you say, people are looking at different parts of the markets. The markets don't just sort of give you one indicator to look at. This is an indicator to say people are not worried.
And the market has also gone strangely quiet about this event that happens on the 12th of March when the Fed facility is running out for all banks who had, let's call it refinancing problems.
Yeah, I mean, but it's running out for a reason. I mean, it was just badly constructed. People were arbitraging. The banks were, I mean, this facility is priced at 1 year overnight index swaps less 10 base points or something like this. And effectively, banks were able to finance themselves at a very low rate. So 50 base points lower than where interest on reserve balances were. So they borrow money from the Fed at, let's just say, 4.5% or 5%. And then they go back to the Fed and say, oh, I'm putting it in my reserves. Can you give me 5.5%? And they say, oh, yes, thanks very much. So the banks were arbitraging a poorly constructed instrument. And obviously, as people started to build in rate cut expectations, this emergency facility got cheaper for them to use as a financing tool. The Fed cottoned on. They said, okay, we're going to cancel this thing. If you want to borrow money, please use the discount window, the emergency thing. It'll be fine. We'll give you the cash. And so they're trying to force people out of the kind of this emergency tool into the original emergency tool. Whether that's enough, whether that works, whether banks go and do that stuff, I honestly don't know. But that emergency thing was a stopgap, and then it was an arbitrage tool, and now they have to kind of find another way to get money to the needy rich banks.
Yeah. Well, let's finish off with talking my book again. Our hardcore viewers, the 300 of them, will probably remember that in January we opened up straddle on the S&P, simply saying, I don't know, will we see a melt up or will the market correct? And volatility was cheap. And we went a bit further out, 1 year options that has delivered really, really nice return right now. So I'm thinking about at least hedging my delta in this position, or maybe taking it off the market and rolling my long put engagement up a little bit. And what finally brought me to that conclusion was the title of The Economist. We started in Germany, and now The Economist shows this beautiful title page of a bull lifted up by balloons. And the question, obviously they are clever, they're good journalists. Well, most of them are with a question mark. But the question is, how high can markets go? I've seen that all before. The market is frothing at the edges. We can see that here from all statistical observations. What we have seen in the market is we are now very far away from the averages we usually see. And I can't tell you whether we see a huge crash or not, but what we're going to see soon is a correction in the market, without any doubt. Seasonalities are also playing it. That everything seems to be happening in March, Nick. I lost a fortune once in March 2008 when Bear Stearns folded.
Right.
I made a fortune in 2000 when or 2001 when the Neue Markt started folding. And that was always the time when we had these beautiful pictures on obviously, I'm not working in a bank anymore. One of the biggest indicators we always had, and I wrote an article at Macro Hive about that, the best indicators you could possibly see, people can find that on my website, is when the guys of the board are standing behind you on the trading floor and giving you good advice. That usually works perfect when the market has just corrected by 30% and they instruct you to sell everything you have. Yeah. Even you had the lower volatility is at 100. But I've also seen the other side, when they're coming in with swagger and telling, we're hiring another 30% investment bankers because everything is beautiful and we'll never see a bear market again. At the moment, maybe that's the final words. You read articles that Citigroup is culling a lot of people. Goldman Sachs is still doing it undercover. So the banks, the good banks, seem to be sniffing out that their level of employees is not sustainable for the long-term future in financial markets. Maybe that also a bit of caution here in this scenario.
Yeah. We didn't talk about gold or Bitcoin, but that's for another
Oh,
day.
we keep that for next week because
Absolutely.
Bitcoin is something I find very interesting. I've answered in an article a question about Bitcoin. You know my theory, yeah? Obviously, I was not a fan of Bitcoin because you could switch it off and that's it. I came around because Bitcoin
And what,
is...
you can't switch off NVIDIA? What?
Yeah, well, you can't switch off gold, for example. A lot of the money that used to go into gold in these scenarios is going into Bitcoin. And I get the point, yeah. And if money, real money, is for me a store of value, I always had this problem. All these guys chasing Bitcoin are chasing it because it could become the new money, not currency, the new money. But nobody wants money where I have a Bitcoin in the morning and it buys me a cappuccino, and the evening I want to kill myself because it could have bought me a car. Yeah, so the use you would get out of new money is lower volatility, and lower volatility doesn't have growth rates where a lot of guys are saying Bitcoin will be by the end of the year at 100,000, 150,000.
Yeah, I mean, I think that's not unreasonable, but I understand one thing: the coffee in the morning and the car in the evening is because the US government is increasing their debt by 100 billion every 4 days. So, and that's the devaluation of money, and so you need something else. You need
Oh yeah,
to.
we talk about that next week because I
Okay,
also
then
I came across a
save
great
it.
chart. Maybe that's the last thing by one of our colleagues, Alfonso Pecadiello. He posted this and said, "Look at the relationship of how much money." Yeah, and he took not all central bank money. He took just money people actually can spend, corporates, private guys, in relation to gold, and gold's 20%. In relation to Bitcoin, it's 3 to 4%. So if you want to be extremely bullish on Bitcoin, well, there's uh, a lot of space to the upside. Or if you're more like me, maybe I have the most honest approach to Bit because I was never invested. I never lost money in Bitcoin. You became rich and poor and rich and more rich again with this whole Bitcoin malarkey. But if I'm on the outside, I'm just mesmerized. I'm puzzled by it. Yeah, I tell you,
Fascinating.
I tell you all on air when I'm tempted again to invest in another dodgy coin because somebody tells me it's 80,000% performance. That was the last time actually. Bitcoin had its high, and one of my former students called me and said, "There's a new coin coming out, and Thorsten, you should invest into it. We expect that it will make 80,000%." And honestly, somebody like me who never invested in this dodgy money, I thought, well, I should put 10 grand in that, because I could become a billionaire overnight. I always wanted to be a billionaire overnight. That's when I knew, okay, Bitcoin, we must have reached the absolute top if somebody like I start thinking about getting rich overnight. Wow.
Okay, well, I'm still waiting for you to buy NVIDIA and before you buy Bitcoin. So that's one thing at a time.
Yeah, no, the next thing I'm going to do a probing trade again on NVIDIA, selling a call spread on top. And wait, if I lose money on that again, I'll wait a little bit longer. Otherwise, if I start making money with that, I'll start seriously considering to the downside a little play. But again, it's just a play. We can afford that because we're old and have gray hair.
Absolutely.
And a more relaxed approach to the market. So, Nick, I want to thank you very much. Let's focus next week on Bitcoin and gold. Let's make a thing
Very
out.
good.
Maybe you could get your magic charts out and give us a little overview about what the Elliott Wave theory says for these markets.
Indeed.
Huh?
I'll have a go.
Thank you very much for your time. I hope you have a good man always competes against his older self on the golf course. Enjoy that, and thank you
Thank
very
you.
much again. And to all of you who viewed this hopefully shorter again today, little show of ours, subscribe, like, share with everybody you like, because I think if you listen to the nuggets, there are some very valuable trades somewhere in between, but this is not investment advice in this sense. Thank you very much and see you soon. Bye-bye.
Bye-bye. See you, Thorsten.